Recently, South Korea's share market experienced sharp turbulence. Excitement around artificial intelligence and semiconductor companies attracted large numbers of retail investors. Many did not invest using only their savings. They borrowed money, traded on margin, or bought leveraged products designed to multiply market gains. When share prices rose, leverage made the profits look spectacular. But leverage also works in reverse. When prices suddenly fell, losses multiplied. Some investors faced margin calls and were forced to sell, pushing prices even lower. The people most affected were often ordinary retail investors, sometimes called South Korea's ants, who had entered the market hoping to benefit from the technology boom. This story may sound modern, but the same pattern appeared almost 400 years ago. In the early 17th century, the Netherlands was becoming one of the world's wealthiest trading nations. Tulips, originally from Central Asia and introduced to Europe through the Ottoman Empire, arrived in the Netherlands near the end of the 16th century. Their unusual colors made them rare, fashionable, and highly desirable. Because tulip bulbs took time to grow, traders began buying contracts for bulbs that would be delivered later. Soon, people were no longer buying tulips simply because they liked flowers. They were buying because they believed someone else would pay a higher price tomorrow. By 1636, tulip contracts were being traded in taverns and repeatedly resold. Prices climbed rapidly, and some rare bulbs were reportedly valued as highly as a comfortable house. Then, in February 1637, buyers suddenly stopped bidding at an auction. There was no single person who deliberately burst the bubble. Confidence simply disappeared. Once traders feared that the next buyer might not arrive, everyone wanted to sell. Prices collapsed, contracts were disputed, and participating growers and traders suffered losses. However, tulip mania did not destroy the entire Dutch economy, as popular stories sometimes suggest. The greatest damage was concentrated among those directly involved in the trade. We have seen this pattern repeatedly. During the dot-com bubble, investors believed almost any internet company would become valuable. Before the subprime mortgage crisis, people assumed property prices would continue rising. During China's 2015 share market boom, borrowed money lifted prices before forced selling accelerated the crash. South Korea's recent turmoil offers the same warning. The investment may change, from tulips to houses, internet companies, Chinese shares, or Korean semiconductor stocks, but human behavior remains remarkably similar. Whenever there appears to be an extraordinary opportunity to make enormous profits, we should remember how bubbles grow. Promoters, commentators, early investors, and market insiders may amplify the most exciting version of the story. As prices continue rising, more people become convinced that the boom cannot end. Eventually, some early participants take their profits and leave. When confidence breaks, those who entered late may be left facing the losses, while leverage and forced selling push the market into chaos. We have seen this cycle many times. History does not repeat itself exactly, but human greed, fear, and the desire to follow the crowd return again and again. When an opportunity appears too good to be true, it should not be treated as guaranteed wealth. It should be treated as a warning to slow down, investigate carefully, and ask who benefits from the story. The real question is, when the tide recedes, who will be revealed to have been swimming naked?